Hello everyone, my name is Murtaza Quaid and I welcome you all to the very first lecture on the topic of consolidation, also known as group financial statements. With this lecture today, we are beginning one of the most important areas in the world of financial accounting and financial reporting. My friends, consolidation is not just about one standard. In fact, in this topic, we will be covering multiple accounting standards together. It's like a package deal. 3 different standards coming together to form one powerful concept. We will be covering IFRS 3 business combinations, IFRS 10 consolidated financial statements, and IAS 27 separate financial statements. So yes, these 3 standards together make up this topic we call consolidation. My friends, in today's lecture, we are going to have a brief overview of this topic. We will talk about the basics of consolidation, what it actually means, what is the concept of group, what we mean by control, what consolidated financial statements are, and who exactly needs them to prepare. It's going to be a very basic and conceptual discussion today. We won't dive into technicalities just yet. That will come gradually as we move forward through the lectures. Alright, now let's start with a very simple term, and that is the word group. So what is a group? Well, it's quite straightforward. A group simply means a parent and its subsidiaries. A parent company and all the entities that it controls, these together form a group of companies. Now, let's break this down a bit more. If we look at the definition of a parent is an entity that controls one or more other entities. So if a company has control over another company or even multiple companies, then that controlling company is known as the parent company. And what about the company that is being controlled? That company is called a subsidiary. So a subsidiary is any company that is controlled by another entity, which in this case is the parent company. So once again, a parent company along with its subsidiaries, all grouped together under one umbrella, is what we call a group in accounting terms. Now, if we closely analyze the definition of the parent and subsidiary, you will notice that everything revolves around one keyword, and that is control. Control is the core factor that creates the relationship between two companies. The company that exercises control becomes the parent, and the company being controlled becomes the subsidiary company. So now the question is, what does control actually mean? Well, according to the standard, there are 2 main criteria that must be fulfilled in order to establish control. Number 1, the investor is exposed to or has right to variable returns from its involvement with the investee. And number 2, the investor has the ability to affect those variable returns through its power over the investee. Let's break this down further. If one company is exposed to the profits or losses of another company, in other words, it has a right to variable returns, and at the same time, it also has the power to influence those returns either through decision making or through its ability to govern financials and operating policies, then we can say that control exists. And once control is established, we can say there is a group relationship between the parent and the subsidiary. Typically, the parent will hold controlling shares in the subsidiary, which means it can influence or even dictate the decision making of that subsidiary company. And because of this control, whatever profit or losses arises from the subsidiary's operation, a portion of that profit or loss will be allocated to the parent company. So once again, for control to exist, the investor, that is the parent company, must have both. Number one, a right or exposure to variable returns, that is profit and losses. And number two, the ability to influence those returns through its power over the investee. When both of these conditions are satisfied, control is established and the parent-subsidiary relationship is confirmed. Now, as we discussed earlier, in practical situations, control between companies is usually established when one company acquires the controlling shares of another company. Now the question is, what exactly do we mean by controlling shares? Well, my friends, controlling shares simply mean that I hold enough voting rights in another company to be able to make decisions according to my wishes. In other words, I need to own a majority of the voting power. And for that, the majority rules apply. Meaning, if one company holds more than 50% of the voting right in another company, then it is in the position to control that another company. So if a company acquires more than 50% shares in another company, then the investor becomes the parent and the company being invested, it becomes the subsidiary. Because the parent now owns more than half of the voting power, it can take all the decisions. It can control the board, it can approve strategies, and it can effectively run the business of that subsidiary company. Now pay attention for this part. I said more than 50%, not 100%. That's an important point. You don't need to own the company fully to have control. Even if the parent owns less than 100%, let's say 80%, it still holds controlling shares because it is more than 50%, and that's enough to establish full control. Yes, control is considered to be 100% for consolidation purpose, even though the parent company owns less than 100% shares of the subsidiary company. Let me give you some examples. Let's say we have two companies, Company A and Company B. In one case, Company A owns 100% shares of Company B. That's full ownership and obviously full control. Now in another case, Company A owns 80% shares of Company B. This is not full ownership. It's not 100%, but still it's more than 50%. And that's the key. Since Company A owns more than 50%, it has controlling powers. It can take all the decisions related to Company B. So even though it only owns 80%, the control is considered to be 100% from the consolidation points of view. Now, let's talk about some rare and exceptional cases. Sometimes it may happen that a company owns less than 50% shares of another company, say 45% of the shares, and yet it still controls that company. Let's take an example. Imagine Company A holds 45% shares in Company B. That's obviously less than 50%, right? But now, look at the remaining 55% shares. These shares are spread across hundreds or even thousands of small shareholders. Some hold 1%, some hold 2%, some hold 5%, but none of them individually has any significant influence. In such a situation, it is highly unlikely that all such small shareholders will come together and take collective decisions. So even though Company A owns only 45% shares in Company B, it is practically in a position to control the Company B because the remaining shareholders are so scattered and disorganized that no one else can challenge the Company A's influence. And in such cases, my friends, even though the shareholding is less than 50%, we still say that the control is established 100% because Company A is in effective control of the decisions and the directions of the company B. Let's look at another example. Company A again has 45% shareholding in company B. Now suppose another 10% shares of company B are held by company A's bank, and the bank has officially agreed that it will vote according to the company A's instruction. Meaning, whatever voting right the bank has, they will be exercised as per the company's A direction. So what do we have now? Company A directly hold 45% shares, the bank hold 10% shares and votes on company's A behalf. So effectively, company A now controls 55% of the voting right. Even though it legally owns just 45%, but in substance, it controls more than 55% of the decision making. And that's what matters. Substance over form. So again, in this case too, company A is said to have 100% control for the purpose of consolidation. Alright my friends, let's now go through a few more examples to better understand the concept of a group. Now, in the definition of the group, we said a parent and its subsidiaries. These subsidiaries, by the way, can be either direct subsidiaries or indirect subsidiaries. Let's take an example to explain this. Suppose we have a group structure, something we called a vertical group. Now in this structure, let's say company A holds 60% shareholding in company B. So company A controls company B because it owns more than 50%. That part is clear. Now company B holds 70% shareholding in company C. So company B controls the company C. Now think about it. If company A controls company B and company B controls company C, then effectively company A also controls company C, right? This is what we call an extension of control, where control passes down the chain from one entity to another. So in this example, company A is the parent company, company B is the direct subsidiary of company A, and company C is the indirect subsidiary of company A because company A is controlling it through company B. And this kind of group structure is what we refer to as vertical group. So to summarize, company A has direct control over company B through 60% shareholding. Company B has direct control over company C through 70% shareholding, and therefore company A has indirect control over company C. That's why we say in a vertical group structure, extension of control is applied, and company C becomes part of a group even though company A does not directly own its shares. Now, my friends, there is one more concept that you will come across later in this topic, and that is called effective holding. Right now, I am just telling you how to calculate effective holding because we will use this figure later when we move into the practical questions, practical illustrations, and start doing calculations in the consolidation chapter. But listen carefully. We do not use effective holding to establish control. Must remember this point. So what is effective holding? Let's say company A holds 60% shares of company B and company B holds 70% shares of company C. Now if you multiply these two percentages, 60% of 70%, you get 42%. That means company A has an effective holding of 42% in company C. This is just mathematical calculation to determine how much indirect ownership company A has in company C. So again, what is effective holding? It's simply 60% of 70%, which is 42%. That's how much company A indirectly owns in company C. But, and this is important, even though effective holding is 42%, this number is only used for calculation purposes. It has nothing to do with determining control. The question of whether company A is parent company and whether company C is subsidiary company will be based on the actual control, not on the basis of percentage of effective holding. In this example, company A controls company B and company B controls company C, which means company A ultimately controls company C, even though the effective holding is less than 50%. So don't confuse effective holding with control. Control is established based on the power to govern, not just percentages. In the same way, let me now introduce you to another group structure, which we refer to as complex group or sometimes a D-shaped group. Let's walk through an example to understand this better. Suppose we have company A. Company A owns 60% shares of company B. That's more than 50%. So clearly, company A controls company B. 100% control is established. Now, let's bring in company C. In company C, company B owns 25% of the shares and company A owns 30% shares. So what do we have here? Company A directly holds 30% of company C. Company B, which is already controlled by company A, also holds another 25% shares in company C. So if we combine the shareholding of company A and company B together they hold 55% of company C. And that's the key. Because together they hold more than 50%. Company A through company B controls company C as well. So in this case, company A is controlling both company B and company C, even though its own direct shareholding in company C is just 30%. Now let's calculate the effective holding of company A in company C. Company A has 30% direct shareholding. That's simple. But what about indirect holding? Company A owns 60% of company B and company B owns 25% of company C. So we calculate 60% of 25%, which is 15% indirect holding. Add the 15% indirect holding to the 30% direct holding and you get 45% effective holding in company C. But once again, and I want to stress this effective holding is only used for the purpose of calculation. You might need it in practical questions later, like for calculating group retained earnings on non-controlling interest. However, when it comes to establishing control or determining the parent-subsidiary relationship, we do not use effective holding. We look at gross holding, meaning the combined shareholding of the parent and its control entities. So even though the effective holding of company A in company C is only 45%, the gross holding, that is company A and company B together, is 55%. And because that's more than 50%, control is established and company C is considered a subsidiary of company A. We will use the effective holding in later numerical questions, but for now, just remember, control is based on decision-making power, not on whether the effective holding is above or below 50%. Alright my friends, so far we have discussed the basic concept of what a group is, who is a parent, who is a subsidiary, and in which scenario control is established. Now let's move forward and talk about financial statements, more specifically consolidated financial statements. See, we know that every company at the end of each accounting period, usually at their year end, prepare its own financial statements. These are called separate financial statements. But here is an important point. Whenever there is a group formed between a parent and one or more subsidiaries, the ultimate parent of that group takes on an additional responsibility. That parent is required to prepare something called consolidated financial statements. And what about subsidiaries? All the other companies in the groups, that is the subsidiaries, will just prepare their separate financial statement. They don't consolidate anything on their own. Now, according to Companies Act 2017, whenever a group is formed, each subsidiary must prepare its separate financial statements, and the parent company is required to prepare both its separate financial statements as well as the consolidated financial statements of the entire group. So from a local law perspective in Pakistan, the parent company has dual responsibility. But from an IFRS perspective, only consolidation is mandatory. My friends, in the upcoming lectures, we will also learn how consolidated financial statements are actually prepared. But for now, let's just have a brief discussion on what exactly consolidated financial statements are. So first, let me read the definition for you. Consolidated financial statements are the financial statements of a group, that is, the parent and its subsidiaries, in which the assets, liabilities, equity, income, expenses, and cash flows of both the parent and the subsidiaries are presented as if they belong to a single economic entity. So what does that mean? It means that in consolidated financial statements, we don't treat the parent and its subsidiary as separate companies. Instead, we treat the entire group as one single company, as if it were a one unified business. So there is no separate status of the parent, no separate status of the subsidiaries. We consider all of them together as one single economic entity. And then we prepare the financial statement of that group as if we are preparing them for a single company, which means we will take 100% of the assets, 100% of the liabilities, 100% of the income, 100% of the expenses, and 100% of the cash flows, both of the parent company and the subsidiaries, and we will present them together in the consolidated financial statements. Now, some of you might be thinking, sir, what if the parent company does not own 100% of the subsidiary shares? What if it only owns 80% shares or 70% shares? Do we still consolidate 100% of the subsidiaries' assets and liabilities? And the answer is yes. We will still consolidate 100%. Now you might ask, why? Here is the logic. Let's go back to the basic definition of an asset. What we learned from day one, an asset is a resource controlled by the entity, not necessarily something fully owned. So even if the parent company owns only 70% of the subsidiary, but that 70% gives it more than 50% voting right, and with that comes the power to control the decisions of the subsidiary. That means the parent has control, and therefore the subsidiary is now considered a controlled resource. So based on that control, the entire subsidiary becomes part of the parent's consolidated group, and we consolidate 100% of its assets, liabilities, income, expenses, and cash flows. That's the reason why, even with less than 100% shareholding, we still consolidate everything 100% in the group accounts. So my friends, in today's session, we discussed a high-level overview of consolidation. We looked at what is meant by a group, the concept of parent and subsidiary, when control is established, and what happens in the process of consolidation. In the upcoming lecture, we will go into much more details, and then We will start working through practical illustrations step by step. Let's end today's lecture here. Thank you for watching.